Hello, welcome to another podcast for the Advisor View. I'm Josh Heil, the CEO of Citizen Mint, and I have Guy of Oui
G.
Financial.
You can say G.
G of Oui
Yeah.
Financial with us today, so G. Sorry. Give us a little bit about your background and the story behind it.
Yeah. So actually started my career as a financial advisor not that long ago, in 2018, and before that I was in tech. So I was actually a project manager. I've been a project manager before that for 20 years, in small companies like Amazon, Fitbit. I joined Fitbit when it was a startup with 300 people, and when I left, it was like 2,000 people, and then they got acquired by Google. So, and in France, I'm from France, obviously, as you can tell from my name and my accent. I'm from northern France, and I worked 10 years in Paris when I was a consultant, and I used to actually reorganize companies. So my background is in reorganization of companies, optimization of processes, and things like that. And so, 20 years being in tech, I was a little tired. I wanted to do something else. Maybe it was my midlife crisis. I don't know. But at early 40s, I was like, I'm 48. I was like, okay, what do I want to do in the next 20 years of my life? And I wanted to help people, and I like personal finances. And so I passed some certifications, and I started my firm at that time, working with French people and French American families in the US, so all over the US. We Financial, OUI Financial, is in 30 states, more than 30 states now. So we're the go-to financial firm for French people and French American families in the US. And last year, I decided to create a group called the Oui Financial Group, WE Financial Group, with a lot of brands in it. So we kind of like we're not an aggregator now, meaning like we're not like the I don't know, Carlson or something like that. Um, we don't do only the infrastructure. We have multiple brands when we do also the marketing and everything, and it's part of the same group. So we share the same infrastructure, but we have different brands for underserved community. For example, French people with OUI Financial. We also have a brand for therapists with Financial for Therapists. We have a brand for people with ADHD, so with Financial Focus. We have a brand that is linked to somehow Citizen Mint a little bit. It's called We Financial Impact. It's for nonprofits. It's pro bono work. It's low-income families, financial literacy, everything that doesn't make us money, basically, because we do most of in that branch. We do most of the thing pro bono, and we have We Financial, WE Financial, when it's more like for people wanting to borrow, and that's going to be linked also to Citizen Mint, and I will tell you why after. Who wants to borrow against their investments. So instead of selling, they have a concentrated position in one stock, or they have a portfolio that have been doing well, and they have a lot of capital gain, and they want to invest in something else, like Citizen Mint, for example. Instead of selling their investments, we're going to borrow against it. And it sounds like a security-based loan, but it's not. It's actually something else that is pretty new, and it's at 4% interest rates, and it's tax deductible as capital loss. So it's called box spread, and we have a branch of the We Financial Group that is specialized in that. And we use it with our clients to invest in Citizen Mint, and I will explain the system a little bit later. But that's so basically we're growing pretty fast. We manage about 160 million in assets that we manage directly. Actually, we have a lot more that we don't like, for example, for clients with Citizen Mint, we have millions of dollars, and I don't count that in AUM because we don't
Yeah.
bill
Yeah.
on that. But what we bill on is 160 million. And I was at 100 million in end of 2024. I hired 5 people in 2025, and now in 2026 we're growing fast. So
Yeah.
that's the situation right now.
So, and where do you see most of your growth coming from? Like, that's a lot, and a lot of things growing at one point in time. So is there one specific area? Is it online marketing? Is it referrals? Is it somewhere else?
Oh, in terms of actually, and we're working on it in 2026. It's not referrals that much. It's more and more, but I was so busy when I was by myself. I was so busy even without referrals that
Mm-hmm.
I didn't need to uh, work on asking my clients for referrals. But we're working on that. We're working on being more thoughtful about telling our clients like, hey, you like the work we're doing with you, help other people,
Yeah.
bring them to us, and we can help them. And we have also a different, like we do hourly financial planning on top of AUM planning. So and financial planning. So we have a lot of clients that just come for 2 or 3 hours, and we create a comprehensive financial plan, and then they do their investment by themselves. And then sometimes 2 or 3 years after, they come back to us and say, "Oh yeah, I totally screwed up. I went out of the market. I didn't come back in. I don't know what I'm doing. Help us." So usually
Yeah.
it's how it works. But we have hourly and we have AUM. And so it's mainly marketing. We do a lot of webinars, and the webinars are in French and in English. In our French webinars, we have about 500 to 600 people signing up. So
Oh, wow.
that's a lot.
That's
Yes.
incredible. Yeah.
Yeah,
That's really good
because
for webinars.
yeah. And so every month we have 500, 600 people signing up, and about 150 coming live, and the others use the replay. And so we cover, like, we have once a month. So we talk to, or actually probably 5,000 or 6,000 people see us every year.
Mm-hmm.
It's a lot.
Wow.
And
Yeah.
so that's why we're growing so fast. And how we do that? We have a database of French people in the US.
Mm.
We can identify, have a marketing person that can identify French people in the US, and we send them the webinar. They're free.
Yeah.
They're really details. They're 1 hour and a half to 2 hours, and it does two things. First, it helps people knowing us. Two, it filters them. Like people who just have a few questions, we don't want them to spend an hour with us. We'll
Yeah.
answer the question for free.
Yeah.
And if they have a more complex need, then they can work with us. And that's one of the problems I see with financial advisors sometimes is they try to get as many people. That's not what we're doing. We try to filter as much as we can. Like that, people who are actually we spend time with, they really need us.
Mm-hmm. And is
That's
there a
the thing.
specific demographic beyond French? Is there a specific demographic that your clients fall into? Is it mid-career? Is it later in their career? Is there something? No.
It's 30 to 60-year-old or 65-year-old.
Mm.
For OUI Financial, it's French people. For other brands, it's pretty much anyone.
Yeah.
Um, it's mainly, people in their 30s. They're not, they're like beginning of their career. They feel like they're busy with their job and things like that. They don't think financial planning that much. People in their 50s, mid 40s, early 50s, they're getting worried about their retirement, and they have kids, and they want to um, plan for colleges and stuff like that. That's when they call us.
Got it.
So
Got it.
most of them are like 40s, between 40 to 50, but we
Yeah.
have the youngest is probably 25 and the oldest is 65, 70
Yeah.
probably. But
Okay.
most of them are 40 to 50. And most of them, so what we do in terms of asset under management is we use seeds investor because we can invest with people values.
Yeah.
Because for most of our clients, 80% of our clients, when we give them the questionnaire, the investment questionnaire, they want to put their values in. Whether it's like environment, the most common one, but there are so many more. Like we have environments like integrity, all this stuff, and we also they can exclude also uh, like I don't know, defense stocks,
Hmm.
oil and gas, and things like
Yeah.
that. And so a lot of our clients, again, 70 to 80% of people have some values that they want to implement.
Yeah.
And so one of the challenge that we had at some point is it's pretty common to be able to exclude things and add values when it comes to stocks. It's a lot harder when it comes to non-traditional assets,
Hmm.
you know.
Yep.
And so when it comes to real estate, um, I don't know, infrastructure, uh,
Yep.
things like that, it was really hard to find something that's, like when we talk infrastructure, say, hey, do you want to invest in a pipeline?
Yeah. No.
No, not for my clients.
Yeah.
Usually not for my clients. And so that was one of the challenge a few years ago. It's still a challenge. I mean, again, with Citizen Mint, it's easier, but I think it's pretty. It sounds like pretty niche, but actually, it's not.
No,
Because
it
one of
isn't.
the value proposition for my clients is hey, investing with an impact is important for you. You the stock market is not the only place you can do that.
Yeah, exactly. Yeah. Maybe you can talk about just how, like, well, and I know you have a lot of different brands, but OUI Financial approaches wealth management differently, and also kind of how your international perspective shapes how you kind of think about wealth and lifestyle.
Yeah, We Financial, UI Financial is still the core of the group,
Yeah.
because it's the oldest brand, and
Yeah.
so it's still where most of our clients are. Um, so how do we approach like international
Yeah. How do you
planning,
how do you
things like that?
see you approach wealth management differently? And maybe how does your international perspective, obviously having an international perspective is very different than having just a US perspective. Do you think that plays into how you approach wealth management differently or not?
Um, I don't know if it's so. Yes, for sure, it does change our perspective. Um, I think two things are shaping the way we invest or the way we approach whether it's investments or financial planning. The first one is my background in tech.
Hmm. Yeah.
So in general, I'm an early adopter when it
Yep.
comes to investment, a new type of investment. I do my due diligence, things like that. But like for example, this box spread, I was explaining this possibility of borrowing money to invest in something
Well, let's
else.
talk about it. Tell me about that. Tell me about how
Yeah.
box spread works.
So basically, it's something that exists since the 80s, um, but it used to be done by for people with tens of millions of dollars. Like really rich people, and you had to call the stock exchange, say, "Hey, I want to set up a box spread." So it's based on options,
Yep.
based on the S&P 500. It can be based on anything, but the way we do it is based on the S&P 500. So it's like options. So it's derivative. It's complicated. You need to be specialized in it. And so before it was automated 2 years ago, you had to call. And so people were answering the phone. They didn't care if you had like 1 million or 2 million. It's nothing for them. They need tens of millions of dollars to do it, to even bother to do it. But no, everything goes through a new system that is automated. So it democratized this possibility.
Mm-hmm.
And so it's not very common now, but I think it's going to grow like crazy in the next 3 to 5 years. Everyone's going to do it. Why? Because as I said, it's like borrowing against your portfolio, except that's not borrowing. You create position on the market and via options, and you have different legs, different line of options, and they all somehow cancel each other. So whether the stock market goes up or goes down, it doesn't change anything because it cancels each other. But the difference of all this cancellation is 4%. And that's what you pay someone else who's on the other side of the trade. You pay this 4% to him or her. And this 4%, because it's positioned on the market, doesn't impact your credit score. It's considered a capital loss. So you do a box spread and the interest is $40,000 a year. This $40,000 is a loss. You have a gain, wherever the gain is, as long as it's considered capital gain. $40,000 of gain, $40,000 of loss, it cancel each other. So don't pay taxes.
Wow. Okay.
So it's 4% before taxes. And because it's not like a loan, it doesn't answer the same criteria. It's not considered a loan for anything, for credit score or for anything. I said that it's a loan because it's easier to explain to clients, but it's actually not really a loan. There are some risks, like your portfolio cannot drop. It's like a security-based loan. You cannot owe more than, you cannot owe more than what you have. So that means if you borrow $600,000 on a $1 million portfolio cannot drop more than 25%. But that's my job to manage the risk.
Yeah.
So we use it for a lot of different things. And my international perspective to go to your question, buying a property in France. You can go through a bank, not a US bank. You have to go through a French bank. Really hard, really complicated, really document heavy. It takes like 3 to 4 months just to have a loan. I mean, it's a mess. And so by doing a box spread, we have a $1 million portfolio. We borrow $600,000. With those $600,000, we can buy whatever we want. Property in France, property in the US, other investment not linked to the stock market. So for some clients, we do that. Like they say, hey, I want to diversify my assets. I want to buy real estate. I want to buy like something different, infrastructure project, real estate, things like that. And for them, we're like, hey, do not sell money from your portfolio. Keep the 1 million and it's going to grow. Borrow $200,000. And as long as these $200,000 do more than 4%, that's what you get.
Yeah. And how long does it last for, the box spread?
Yeah, I'll finish my my thought and then we'll talk about that. And so those $200,000, we'll take them and we invest in projects, like in projects in season means.
Yeah.
And they get you like 6, 7, 10, 20%. And then you still have your 1 million portfolio, your 200, they exist in two places. One in 200, the 200,000 goes up with the stock market or down. And then the 200,000 goes up in season mint. It's not linked.
Yeah.
So that's why it's great. So those positions, there are multiple ways to do it, but basically you can borrow up to 5 years. So there's two weird things with the box spread. One is you don't pay monthly. You pay once a year or once after the 5 years. So you borrow, for example, $500,000 on 5 years at 4%. It's fixed. It will be 4%. You don't pay anything for 5 years. And at the end of those 5 years, you owe $100,000. 20%, 5 years at 4%, 20%, $100,000, and you pay then. You don't have to pay the principal. You can renew it. And that's actually what we do with clients. We keep renewing it forever. And there are reasons for that. Or you can pay anytime you want, pretty much.
Got
you
it.
do what you want. It's super flexible. But
And
what's
then,
interesting, yeah.
oh,
Go ahead.
going. Well, I was just going to say, does it cap your upside at all on your underlying positions?
No.
Okay.
No, it doesn't cap your upside. But again, you have to be careful with the risk. Because if you borrow 60% of your portfolio and you're 100% in the S&P 500, for example, then can drop 30%. And then you will have a margin call. Schwab will tell you, because we do it with Schwab, Schwab will tell you, hey, you have to sell some position. You're too close to those $600,000 that you're. Worst case scenario, they sell it for you. So they sell everything and you had $650,000 all in cash.
Yeah.
But you didn't lose anything because this $600,000 already exists somewhere else. They still exist. The only thing is that instead of selling today, removing it from the stock market and buying something, you don't sell it. We just give you the money. We give you the cash and you invest it. And so the money still exists at two places. And that's what it's weird for people and for financial advisor too. Like, what? But it exists in two places. So we're very, very careful at We Financial about the risk. Like, we don't even get close to get a margin call.
Yeah, just like, super conservative on how much you're.
Yeah, but we need to have the right balance to still make money more than 4%.
Yeah.
But not taking too much risk. That's why I talk about 60%, because usually it's 60 to 70% max that we can leverage. We can borrow 85%. But if you borrow 85% of your portfolio cannot drop more than 5%.
Yeah.
It's impossible. So that's why 60% is a sweet spot usually, or under. We can go up to 70% sometimes. But what's great is, for example, what we do with Citizen Mint and some of our clients is we borrow money. The project goes Citizen Mint project 2 years, 3 years, 4 years.
Yeah. Yep.
Citizen Mint reimburse the pay back everything.
Yeah.
Well, we put a little bit more money in the portfolio. We keep some money in Citizen Mint that continues to grow. We invest. We put some money in the portfolio, and just the portfolio went up, particularly these past 2 years when the market went up.
Yeah.
The beginning of the year went up a lot. On top of that, we put more money. So we started at 60% leverage. 3 years after, we had like 40%.
Yeah.
And also with time, we keep the same amount, but the portfolio grows more and more. And that's why we usually don't even bother pay back the loan, what I call the loan, the box spread.
Yeah.
Because with time, it becomes negligible. It becomes so small. And what's great is with a client say, well, what happened? What? We don't reimburse the loan? Like, no. But what happened when you die? That's the beauty of it. Not that you die, but that is what happened when you die. There's a step-up basis when you die. So instead, let's take two scenarios. First scenario, just you get old. You want to reimburse this loan, this box spread. You're going to sell some stock or some of your investments, and you're going to reimburse it. You're going to pay taxes on the gain you made on those investments. Okay? But if you die, here's what happened. There's a step-up basis. All the gain when you die are not taxable when it goes to your kids. So you have a $1 million portfolio, you have $500,000 of gain. Your kids will get the $1 million.
Yeah.
There will be no tax. So what happened with the box spread is there's no gain. The estate sell part of it to pay for the box spread. There's no taxes here, and the box spread is paid.
Wow.
Abracadabra.
Yeah.
I take the taxes. Abracadabra. disappeared. So a lot of things can happen in the
Yeah.
next 5, 10, 20 years. So, but as of today, it's how it works. As of today, it's how it works. And again, it's not very, box spread is not very common, but it's getting there. And we use a specialized company called Synthetic Fee they do only that. Synthetic Fee does only box spread. That's all they do. They specialize in that. Our
Mhm.
job is to manage the portfolio. They don't do that, but we ask them, hey, we want to borrow 500K. They will do the box spread, 500K. I will give it to the client in cash. It takes 2 weeks to put in place the possibility to get a box spread. It's free. It's just we add the option level in a portfolio, and then 24 hours to get the money.
Wow.
So it's really fast. There's 2 forms to sign at the beginning, and then you get the money like that.
Wow.
24
That's
hours.
crazy. It's amazing.
That's an amazing product. And so we use it a lot to do like things instead of selling. We can diversify. We can do that with some people who have we have some clients who have huge position in one stock and they don't want to sell because of capital gains and everything. So we borrow against it when we can. It's not always the case,
Yeah.
but when we can, we're going to do that. And it's not boring. I say boring
Yeah.
because it's easy, but it's actually not boring.
Yeah.
It's different.
No, I get it. That's amazing. That's a great value add to your clients and something that creates real tangible value, like from a tax perspective. And what do you like? And maybe this is what they value most is paying less taxes. But what do you think clients value most today? What's kind of like the thing that you kind of provide value in that?
Yeah, so that's interesting because that's a good question. Because part of our reflection on where the group is going and what we want to do with the We Financial Group and how we want to serve our clients, we started to talk to them for them to give us feedback. What we do well, what we don't do well, what we can improve, things like that. They didn't talk at all about performance. None of them.
Yeah.
Even if we've been doing great performance.
Yeah.
They didn't talk about performance at all. They talk a little bit about, hey, you help us save taxes, but not that much. What they talk about is values, peace of mind, how we give them peace of mind, and the fact that we at the forefront of what exists. Like when there's a product and that's a good product and it has some value, not values, but value.
Yeah.
And so that's the case for the box spread. We also have something called ETF 351. It's also another type of thing that we do. We can talk about it another time. Citizen Min is part of it. When we met Josh, I was like, yeah, it's good, etc. I was pretty small. And then we talked again a couple of years after, and I was like, wait a second. Absolutely, that's great. Yeah. We gotta use that. And to my knowledge, you were the first I heard doing like infrastructure with an impact.
Yeah.
And so to me, this is new. This is not something I hear about it, but it's more linked to the stock market.
Yeah.
It was not about infrastructure. It was not about like real estate. It was not about that. And so I thought that was a niche that is actually not a niche.
Yeah.
Actually, the proof is that we have hundreds of clients. 80% of them wants to have an impact. They just don't know it exists. They just don't know it's possible.
Yeah. No, and I think that's true. I think it's also like, even when we were starting out, people would call us niche, and I was like, infrastructure is the biggest part of the market, like investing in energy and all these things that are, now it's kind of like everybody's talking about infrastructure and the need for energy.
Yes.
It's like a huge topic, but like 2 years ago, nobody even discussed it.
Yeah, when we met, like I think that was 4 or 5 years ago, it was mainly like oil and gas and pipeline and stuff like
Yeah,
that. It was not like data center or solar panel or things like that.
yeah,
And I think it's just what's crazy. I think it's just the beginning.
yeah,
Despite the political climate against this type of projects, I think it's still it, it's still gonna happen. There's
yeah.
no other choice. Like solar panel, for example, is cheaper than petrol right now
Oh,
because of the iron ore, and
even like
it's
cheaper
the
than
trend.
like,
Yeah,
which is crazy.
yeah. And so economically, it makes sense,
Yeah,
but still, um, um, philosophically, people are against it.
yeah,
But at the end, the economics are that's what's gonna it may take years, but that's what's gonna happen. The economics will work in the um, renewable energy favor. It may take years, push back and everything, but I'm quite sure it's gonna work
and
out.
I think it's really happening. I mean, honestly, like I was, we in Texas. Texas is about to bypass California as the biggest renewable energy state, which will surprise everybody. But
Yeah.
here's even a chart. This is live, real time from ERCOT, which is Texas's power authority, and this shows their real time fuel mix. So they're getting 54% of their current generation of
Look
energy
at that.
from solar, 8% from wind. So you're looking at 61% from just renewables. And that's going up significantly given Texas's geography, which is like West Texas is flat. There's nothing there. You can put a lot of solar panels there with a lot of and then you're looking at power storage is also, going to be going up. And natural gas is a very small portion of their overall energy mix. So
Yeah,
it's kind of
there you
crazy
go.
looking at that.
Yeah, and it's not, we it's happening in front of us, but we start hearing about it, but it's not obvious for everyone.
Yeah.
Like when you hear like drill baby drill, like sure, go for it. Like it's not gonna work.
Yeah, yeah.
It's
It's
like
something.
uh,
I would think, yeah,
it's just a matter of time.
for certain things, but most of the power is really going to come from solar, wind, and with batteries as part of that, just because of that economics of it. With solar, probably the biggest one.
Yeah, that's to me that's obvious. But the what I think we underestimated in the past 10 years, I mean, we overestimated, some people overestimated, some people underestimated. Like some people thought it would go faster
Mm.
and it went slower. But I think people underestimated. Like they thought it will be like the first 5 years it will go super fast, it went slow. And they said, oh, because it went slow, it will continue to go slow, but it's actually going exponential. Like
Yeah,
you show it with Texas, it's going faster and faster. So I think they overestimated at the beginning that it will be fast. And that's why we had, like, I remember like 6 or 7 years ago, a lot of clients were saying, oh, yeah, I want to buy an ETF on solar panel and everything. It crashed completely. It was
so
horrible.
bad. Yeah,
And then the past 3 or 4 years, they went up and everything goes up and all the projects. And
yeah,
yeah, so I think it's accelerating despite the political climate
yeah,
here in the
yeah.
US.
Exactly. And so the opposite that it wins. Um, markets and kind of how you think about how you go clients' portfolios, like how you size it appropriately within their portfolios, how do you think about liquidity and kids? What's important to your clients there?
Yeah, so two things. There are a couple of things that are important for my clients, and that's one of the reason why they don't go to infrastructure that much or as much as I would like them to go. That's because the entry tickets can be pretty high for
Yeah.
some of my clients, like $100,000 or more, and also the liquidity factor. So it's blocked 3 to 5 years. A lot of things can happen in 3 to 5 years. We saw it this past couple of years. And so that's one of the things that they scare off. It's, oh, I'm going to block my money to something that is still not liquid, more and more transparent. But particularly the project you propose are pretty transparent. We can go like in a lot of details, but it's not the case for a lot of projects in infrastructure.
No.
Some of them, it's like pretty vague. Like some of my clients say, "Oh yeah, I read this thing," or "I received an email about this infrastructure project," and I go into the details, and there's nothing. It's just like wishful thinking. Oh yeah, like last time it was like real estate in Hawaii, and there was like fine print. Well, the project hasn't been accepted yet because there was a special authorization because it's on the land that is important for people in Hawaii. And so I'm like, oh no, that's dangerous. That can take years to be approved, if approved at all.
Exactly.
And so, but it's buried. And so, and thanks to AI, actually, you can put the 90 pages document or the 50 pages document in AI and say, look for this type of things.
Yeah.
And then they can give you the page, and then you have to do your due diligence and look at it. But they can save you a lot of time on that. And so a lot of projects like that.
Yeah.
A lot of things like wishful thinking. Oh yeah, if everything goes as planned, it's gonna be like that.
Yeah. Yeah. And that's the main thing for us is transparency and trying to like, here's what you're actually investing in and like discuss it in detail. And it's like, if you need more information, listening.
Oh, the sound is pretty bad suddenly. It cuts. I cannot hear you anymore.
Can you hear me now?
Yeah, it's a little saturated, but I can hear you.
For a second. Sure. But for clients who do all alternatives, is it like 2 to 5% of their portfolio?
No, we go up to, so there's 3 types of alternatives that we use. Okay, there's liquid alternatives, mutual funds, and when I say that can be gold, silver, that can be long short equity and things like that. So that we can go up on the portfolio depending on the level of risk. It goes from 20% to 50% of the portfolio in what we call alternative, because bonds, we don't like them very much. We didn't like them in 2022. We still don't like them, and so we use more liquid alternative in the portfolio, and then there's alternative outside of traditional assets, so a lot less liquid.
Yeah.
And we have 2 of them, and because I work a lot with French people, they love real estate. French people, and real estate is a love story, because in France, building your net worth is buying properties, which is great in France, not so great outside of France. And so the 2 things that we have, and it goes from 5 to, I mean, it depends what, but 20% of there, but not in one thing. It's always multiple things. So for example, Citizen Mint has different projects. We'll put like 3 to 5% in one project. Like we have a client, she has like 4 or 5 projects with you guys. And it's like 5-10%, it's 5% for each project. So total is 25% of your net worth, but it's a bunch of different projects.
Yeah.
So, and because she's really, impact is really important for her, and she really doesn't trust the stock market.
Yeah.
And so, so it's an extreme. Most of the people, it's 5 to 10% in Citizen Mint, 5 to 10% in something that we have. We have a fund in Oui Financial at a company called Percent.com. and it's private credit.
Yeah.
So you lend money to small businesses, and usually it's 5 to 10%.
Yeah. Okay. No, that makes total sense.
But in terms of taxes, it's considered revenue. So
Yeah.
the return is pretty good, but it's considered revenue. While Citizen Mint, depending, and that's, you have to deep dive on the project a little bit, because most of the time it's capital gain. So I like that. I like it. Or what I love is those projects that you have, and when they actually refund you the capital at the beginning. So there's
Yes.
no taxes, and you get money, and there's no taxes.
If our distribution's offset by accelerated depreciation, that's what we like. Yes.
Yeah. It is awesome. Those projects are really good. And so I try to explain to the clients, and they're like, what? Like, yeah, it's like they reimburse what you put, but then
The ITCs return a lot of money. Yeah. Exactly.
yeah, no, that's the best one.
Yes. Yeah. I know those are unique and differentiated and pretty amazing.
And I reduce the risk like right away, because you get your money back in 1 or 2 years, and then whatever is left is grow.
Yeah.
But you already get your capital back.
Yeah, exactly. It's really reducing the risk for clients. And also it's just like, we're usually first lien on a lot of those projects. So it's pretty awesome.
No, that's really cool. Yeah, those are pretty good projects.
So shifting gears, how are you thinking about AI and how that's going to change the environment for wealth advisors, and how are you thinking about utilizing it as well?
Oh man, that's a huge subject. We can do a whole podcast on that.
Yeah.
So I love AI in some ways, and I hate it in other ways, like a lot of people. And like every tool, there's a good side and a bad side. Okay. So the good side for us financial advisor so I'm going to talk about financial advisor in general, and particularly for my firm. So for financial advisor in general, it saves a lot of time. Like emails, etc. I dropped an email with a bunch of ideas, and I asked the AI to put in structure for my clients. So it's still my ideas, and I use AI not to generate ideas, but to put them in a structured way and in a nice way. And so it takes me like 5-10 minutes to write a bunch of ideas, and then it gives me a nice email.
Yeah.
Right. And so that saves me a lot of time. Analyzing documents, really good at it, as long as you ask, because there's less and less. But when I started using it, there were a lot of hallucination. Like they will say, "Oh yeah, it says that," and I'm like, So I learned to ask, "What page?" And sometimes you go to the page and no, it's not in there. So that I'm really careful with.
Yeah.
But it's less with the new versions and everything. It's a lot less than that. I still ask for pages. So every time I don't trust AI in terms of finding the right data, the right place, or interpreting the data as a financial would do yet. So I always use AI as a first pass, then I review it, then I looked into the document myself, but it guides me to where to look in the document. And then I challenge also. It gives me a way to challenge. Like I say, hey, you said that, but I disagree because of this and this and that. And I try to, and then it gives me, like when I do my due diligence on projects, I do this. So it's not AI reviewing the document in a sense. It's like more of an exploration. Okay, what this, what that, where it goes, etc. Then about investments, it's getting better. So that's so how does it impact my firm? Like, oh shit, we're gonna, pardon my French, we're gonna be replaced by AI, and I know it's not going to be the case for my firm. All the financial advisor, their value proposition is, we invest for you. They're going to disappear because AI can invest pretty well already, and it's going to get better and better. But our clients, again, it's not about the way we invest. It's not about the performance. It's about the discussion they have with us. How we interact with them. How we give them peace of mind.
Yeah.
That's the value of a human being. because the problem with AI is like remove intuition. Us as human, in terms of relationship, particularly as financial advisor, we work with people, and that's what's important, and that's what we do in my firm with clients. We don't, we actually don't talk about performance that much. Tell them, yeah, this is the performance. You're not happy? Well, we can be more risky. Oh yeah, but no, okay. So then that's the performance you get. And if clients say, hey, I come to you because I want this better performance, I want the performance of the S&P 500, I'm like, hey, I can guarantee you the performance of the S&P 500 and you don't even have to pay me. Buy the S&P 500 as an
Yeah,
ETF,
exactly.
you'll have the performance. I don't want this. That's not what I'm good at. That's not.
Yeah.
That's an AI can do that. An AI can replace you on that. An AI, at least for now, cannot replace the intuition. Cannot replace the way you interact with clients when they panic and the market goes down, and you're like, "Hey, don't worry, I got you. Do not panic. Do not sell. We are watching it. We are doing things." And sometimes not doing anything is actually the right thing to do most of the time.
Exactly.
And so, but you need to convince the clients. An AI cannot convince someone. We know our clients very well. And so I'm glad that AI is coming because that's going to remove a lot of financial advisor that actually have high fees and don't do, we see that all the time. They don't do much with their clients. They talk to them once a year. They don't look at their overall planning situation, financial planning situation. They just do investments. And when you look at the investments, like 4 or 5 ETF or funds, when they get retro commissions, no, that's not our job as financial advisor. Our job is not to manage portfolio day-to-day manage. An AI can do that. It's build a portfolio that will withstand different cycle of the market, but also interact with our clients and make sure that they are okay in their life. You know, financial advisor, we almost like therapists. You know, we like our clients tell us a lot of things, different things, and so I'm not afraid of AI. I think it's a great tool, but I think some financial advisors should be afraid of it.
Mm-hmm. Anything else you see happening in wealth management over the next 3 to 5 years?
So AI is going to revolution like a lot of things.
Yeah, like
so I think,
which is what you're trying to do to a certain extent.
Yeah. Oh, and AI is also really bad at cross-border financial planning. Really bad. Like we test AI all the time with question about cross-border financial planning. Really bad. It's scary bad. And yeah, and we have some clients say, well, but ChatGPT told me this and this and that. We're like, it's exactly the opposite. It's totally not that. That's the worst thing. And so, so for now, really bad. So that's good for us.
Yeah.
But yeah, wealth management, I hope that we more and more of firm that actually don't give high value to their clients. And when I say firm, that can be big firm. I'm not gonna say name, but really big firm that just what they do is basic financial planning, invest in a bunch of funds that is a mathematical model and that you can do with an AI, but actually don't deep dive on the situation of their clients. Like some of the biggest firm, I mean, our clients pay like 2%. They talk to their financial advisor to review their portfolio once a year, and that's it. We talk to our clients like at least every 3 or 4 months, sometimes every week when there is a situation when they buy a house or things like that.
Yeah.
Like it's not, and our fees is around 1%.
Yeah. Yeah.
And sometimes less. And we don't get commission from how we invest. So I think there was a big trend where the fees are going down, and I think it's going to continue to a certain extent. I think we're almost done with that. I think as a small boutique firm, we had the bottom of the fees. Like, we cannot go down more.
Yeah.
Like, it's really hard to go down more. The way and again, because of my background in reorganization and everything, I dropped the cost of my, like, I don't have an admin. Almost everything is automated. And it's not by AI. Because also I see a lot of AI as a value proposition. Hey, we're going to implement AI for your company. No, AI is a tool. It's not a value. Just because you're implementing AI doesn't mean anything. You have to use AI for something. Like, for example, for us, we're probably going to use AI for complicated process. Like, our billing process is really complicated. And we takes us days, weeks, and we have to review everything, make sure everything is square and fair. And AI can help with that because it's really hard to automate because it's different system interacting with each other. But other than that, I don't. To prep meetings, AI. Oh no, AI can be useful, and we use it for that to review meetings with clients. Like, what did we do well? What didn't we do well? What we can improve? Like, because they have the transcripts and they can analyze a lot of things.
Yeah.
And to make us better, we use AI to improve ourselves. It's a continuous improvement.
Yeah. So here's my last question, and this is maybe what you're doing right now, but something that people don't know about you that would surprise them.
Personally, or
Yeah, personally. Let's keep it personal, or like a hobby that you have.
Well, a lot of that they don't know about me. There's probably two things they don't know about me. One, that I used to be a martial artist.
Oh, okay.
For 25 years. So I did martial arts. And then I switched. The second thing is linked to that. Oh, man, it's not linked to that, but so I started martial arts when I was 14, 15, and I stopped when I was in my 40s. When I had my midlife crisis, and I switched, and I decided to become a runner. And the first few years, and I've never run before. So it's really my 40s. I did a 5K, and I was with a cousin who was a runner, and she passed me like super easily. I was like, and she passed me. She was on her phone because it was Black Friday. Was on her phone shopping, and she's like, "Oh, I'll see you later." And she went, and I said, "Never again." I'm something they probably don't know, but that's kind of obvious. That's why I'm a founder and CEO of two firms. It's that I'm really competitive, extremely competitive, and so after that I said, "No way, it's never going to happen again." And so I started training, and then you get a little out of hand. So I started with 5K and 10K. Then I did a half marathon. Then I did a trail marathon. Took me 5 hours and 40 minutes with elevation. And then I did a 50K 6 weeks ago. Took me 8 hours and 40 minutes because it was 8,500 of elevation. And Friday, I'm going to do this marathon in the Grand Canyon. And no, I feel like, oh, it's only 24 miles. It's not a big deal. I never thought I will think like 7 hours running in the heat and will be it's not a big deal. So
that's incredible. And I'm
crazy.
Inspiring me right now. Let's go.
It's fun. Yeah. It happens, it happens out of nowhere. Like, I was like, I will never do a marathon. Running for 4 hours, not my thing. Too long. I get bored. I know I'm running, but I'm running in nature, so it's different.
That's a little bit easier. Yeah. Well, thank you so much. Really appreciate it.
Thank you, Josh.
And appreciate everything about your firm and what you're building. Okay.
Anytime.